Hello, students. Our new chapter in financial accounting, FY BCom SEM 1 is conversion or sale of partnership firm into a company. As per the Act of Partnership Firm, the membership is limited. The liabilities of partners of partnership firm is unlimited. To solve or remove this limitation, the partnership firm is converted into company or sold to company. When partners want to expand the business or want to take the benefits of limited liability, they would convert the partnership firm into a company. Sometimes the business may be sold to the existing limited company. So this is called as conversion or sale of partnership firm. This is called conversion or sale of partnership firm. Now, here I would like to explain the meaning of limited liability and unlimited liability. Limited liability means where the business owner's liability for debt is restricted to amount they put in the business. That means जितना पैसा लेके आएंगे उतने के लिए ही रिस्पॉन्सिबल होंगे या तो उतना ही पेमेंट उनको करना पड़ेगा. That means the level of risk is less. In unlimited liability, business owner is personally responsible for any loss. I- For any loss means the level of risk is high over here. So this is the difference between limited liability and unlimited liability. Now, in the case of conversion or sale of partnership firm, the books of firms are closed as it is dissolved. So realization account is prepared, and the realization account is prepared in the same way as we used to prepare in the dissolution of firm chapter. Now, here the only difference between the dissolution of firm and the conversion of partnership firm is that in conversion, the sale of individual asset, or you can also say the realization of individual asset or payment of individual liability are not recorded in the realization account. I would again like to repeat this important point that the sale of individual asset or payment of individual liability are not recorded in realization account in case of conversion or sale of partnership firm. Only those assets realization and those liability payment is recorded in realization account which are not taken over by the company at the time of conversion or sale of partnership firm. So this note is very important. So again, I would like to repeat this point also. The assets and liabilities which are not taken over by the company will be realized or paid off, and that will be recorded in the realization account. Now, when the firm is converted or sold to company, it's necessary to calculate the purchase price of the firm. Purchase price is the price that purchasing company agrees to pay for taking over the business of the firm. Purchase price is computed in two ways. The first way is net asset and the second way is consideration method. Now, purchase price is calculated on the basis of assets and liabilities which are taken over by the company. That way or that method is called as net asset method. Okay, that is called as net asset method. And consideration method is a method which is calculated on the basis of equity share capital, preference share capital, debentures, and cash. So, purchase price is a very important term, or you can say a very important calculation in case of conversion or sale of the business. and that is calculated in this two ways. Now, the necessary accounts to be prepared in this chapter are realization account, partner's capital account, cash or bank account. Now, this fourth point is not compulsory, but then also we will practice this accounts in one or two sums. Company account, equity share capital account, preference share capital account, and debenture account. You should have an idea about these four accounts also. So we are going to practice that in few sums. So these are the necessary accounts which are to be prepared. Steps for solving an example. So let us see the steps which we are going to use for solving an example for conversion or sale of partnership firm. I have divided these steps in six parts: step 1, step 2, step 3, step 4, step 5, and step 6. Step 1 is about calculation of purchase price, which is for both the buyer and the vendor. Now, the purchase price is calculated on the basis of two methods. The first method is net asset method. Net asset method. So, under this net asset method, the net asset is concluded as net asset is equal to asset minus liability. Asset minus liability. In this assets, fixed assets are included, investments are included, current assets are included. And under this liability, long term borrowings are included, current liabilities are included. So, net asset means assets minus liability. So, a very important thing which I am going to say now is that only those assets and liabilities are included in this net assets which are taken over by the company at agreed value or adjustment amount. Again, I would like to repeat, only those assets and only those liabilities are included in this net assets which are taken over by the company at agreed value or adjustment amount. And those assets and liabilities which are not taken over by the company will be realized or paid off later on, respectively. So, this is your net asset method. One important thing is that fictitious assets are not included in this assets. Fictitious assets include your P&L account debit balance, advertisement suspense account, preliminary expenses, development expenses, underwriting commission, and etc. The second method for calculating the purchase price is consideration method, which is also known as purchase consideration. So, consideration is equal to equity share capital plus preference share capital plus debentures plus cash. That will give the consideration amount. Now, the answer of consideration method and the answer of net asset method will be same in all the example. In all the example, the answer of net asset method and the answer of consideration method will be same in all the example. Now there is a note. The note says that net asset method is used to calculate purchase price when any one or both of the following two conditions are satisfied. दोनों में से कोई एक या तो दोनों कंडीशन satisfied हैं तब net asset is used to calculate the purchase price. So the first condition says that when the given purchase consideration is incomplete, ये जो consideration है, ये जो purchase consideration है वो incomplete है, सारी values उसमें दी नहीं गई है. Example, balance cash, balance equity share, etc. is given, तो बाकी कुछ missing है. Second, when amount to be paid for goodwill is given in the adjustment directly or indirectly. डायरेक्ट वे या इनडायरेक्ट वे में गुडविल आपको एडजस्टमेंट में दिया गया है. So this is the note which you have to keep in your mind. So here the step 1 is over. The step 1 is about calculation of purchase price on the basis of two method, that is your net asset and consideration method. Now, one thing to be noted is under the net asset method, when any fixed asset is taken over by the company and is valued at book value, in that case, the depreciation fund must be deducted from the book value. But depreciation fund should not be deducted if the new value of the said asset is to be taken. So kindly keep a note about this in context to the fixed assets. Entries in the books of vendor. Now the step 2. Step 2 is transfer the balance from balance sheet, which is very simple step. This is just same like we used to do in dissolution of firm chapter. So step 2 is just transferring the balance from the balance sheet. First, transfer capital and reserve and surpluses. So the capital balance will be transferred to partner's capital account. Reserve and surplus will also be transferred to partner's capital account in the said ratio. Reserve and surplus includes general reserve, workmen compensation fund, etc. B. Transfer assets to realization account. So the journal entry for the same is realization account debit to sundry assets. C. Transfer of liabilities. So the journal entry for the same is liability account debit to realization account. D. Transfer of provision against assets, that is bad debt reserve, depreciation fund. This will be transferred to the credit side of realization account. So the journal entry for the same is bad debt reserve account debit, depreciation fund account debit, discount reserve on debtors debit to realization account. So there is a note that this bad debt reserve, depreciation fund, discount reserve on debtors are recorded on the credit side of realization account. So this step 2 is just transferring the balance from the balance sheet A, B, C, D. So let us continue the second step, that is transfer of balances. So here is the E point, transfer of provision against liability. So the journal entry for the same is realization account debit to discount reserve on creditors. That is transfer of discount reserve on creditors on the debit side of realization account. And F is transfer cash balance to cash account. We are going to prepare a separate cash account and we are going to transfer the cash balance to this cash account on the debit side as to balance brought down. Okay. And if it is not taken over by the company, that is only transferred to the cash account. So the step 2 is very easy. It is same like we used to do in dissolution of firm chapter. So step 2 is transfer of balances. Step 3 is passing the journal entry for purchase price. Passing the journal entry for purchase price. There are two journal entries. First one is purchase price due, and the second one is purchase consideration received, or you can say consideration received. So there are two journal entries. The first one is purchase price due. The journal entry for the same is company account debit to realization account, and the second journal entry for purchase consideration received is equity share capital account debit, preference share capital account debit, debenture account debit, cash account debit to company account. So this is your step number 3, that is passing the journal entry for purchase price. Step 4, solving the adjustment. Now step 4 is all about solving the adjustment. Those assets and those liabilities which are not taken over by the company are realized and paid off. So we are going to pass the journal entry for the same. Again, I would like to repeat, those assets and those liabilities which are not taken over by the company are to be realized and are to be paid off. So the journal entry for the same is as follow. First, realization of assets by firm or partners. The journal entry is cash account debit to realization if it is realized by the firm, and if it is realized by the partner, the journal entry is partner's capital account debit to realization. B. Payment of liability by firm or partner. The journal entry is realization account debit to cash or partner's capital account. If it is paid by firm, then cash will come, and if it is paid by partners, partners capital account will come. So this is the journal entry for payment of liability. So only those assets will be realized and only those liabilities which will be paid off which are not taken over by the company. Okay. C. Dissolution expense which is paid by partner or firm. The journal entry will be realization account debit to cash or partner's capital account. D. Dissolution expense paid by the company, which is paid by the company. So there will be no entry. There will be no entry. So this is your step 4. Step 4 is very easy, solving the adjustments. Step 5, distribution of shares and debentures among partners. Distribution of shares and debentures among partners. The journal entry is partners capital account debit to share capital account or debenture account. The distribution of this share and debentures will be done in the ratio which is given in the example. And if the ratio is not given, then we are supposed to take the closing capital ratio for the distribution of this shares and debentures. So this is your step 5, that is distribution of shares and debentures among partners. Now come the step 6, closing the account. We are going to close the account. The first account which will be closed, that will be realization account, and we will get profit from this account that we will transfer to partners capital account. Then we will close partners capital account, and when we will be closing partners capital account, we will get a balance which we will be transferring to cash account or bank account, and at the last, cash and bank account will get tally. So in this way our sum will be completed. So these are the 6 steps for solving an example of conversion or sale of partnership firm. The very first step was, the step 1 was calculation of purchase price. There were two methods, net asset and consideration method. Second is transferring the balances. Step 3 was entry of purchase price. Step 4 was solving the adjustment. Step 5 is distribution of share and debenture among partners. Step 6 is closing the account. So, if you remember all the six steps, the solving of an example will be very much easy for you all. So, here I end with the theory part of this chapter. Thank you, students.